no, you shouldn't be refinancing at all. If you're going to sell this thing in 2 years, just keep the same interest rate where you're at. If you want to save yourself in some interest, throw a little extra principal at it, and not do it. I told that person no. I could have taken advantage of them. I could have put a deal together where the cost was a little lower, the interest rate was a little lower, and closed a mortgage. But she ended up being one of my top referral partners because she is a hairdresser, does hair for a living. Her job, a big portion of her job is to small talk with her clients while they're doing hair, right? So I ended up doing 3 or 4 transactions that next year from people that she referred over because we consulted the right way, right? We became the consultant, not the transactional guy. So I just use that as an example of how important as a consumer to align yourself with the right people that are going to give you good advice.
Brandon Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC-registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Brandon Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
Don't tell anyone about this, is what she told me. It was my first day in the mortgage business 21 years ago. I was meeting some of the other loan officers in my new office, learning the ropes and trying to find my place. Her name was Terry or maybe Sue, although her actual name escapes the steel vault of a brain I have. His words, definitely a quote, not me. I will never forget what she was telling me. She was talking about overage, and it was as dirty of a secret as there ever was in lending. Overage was how mortgage companies and loan officers made more money and how borrowers were gouged into higher interest rates without even knowing it. I don't think anyone in the mortgage business ever told their client what overage was, but I'm going to tell you about it right now. Back in the day before the mortgage market crash of 2008, loan officers were paid commissions on the loans they originated. The higher the interest rate the loan officer gave the client, the higher the loan officer's commission. Banks paid the mortgage companies extra money for originating higher interest rate loans, and that extra money was referred to as backside pricing, commonly referred to as overage. Mortgage companies encourage LOs to maximize the interest rate they're selling clients. Is this dishonest? Yes. Evil? Maybe. Before we bemoan the banks and mortgage companies that created these incentives that raise their rates for clients and line the pockets of the banks, and mortgage companies keep in mind that the practice of profiting at the expense of their clients isn't all that different than most other businesses. The term caveat emptor, buyer beware, is something my economics teacher in college used to teach us. In our open market system, we, the buyer, have the right to educate ourselves before we buy, shop for the best deal, and in short, be responsible for our own decisions. Unfortunately, there are some bad apples in all industries within our open market system who try to profit as much as possible from their clients, regardless of what the market price should be. People are always afraid of getting screwed when they have to buy a car or buying clothes before they even go on sale. Even grocery stores have played in our fears of getting screwed by offering coupons, double and triple coupons, club pricing, and other discounts. Feel free. The bottom line is, in America, we are free to sell at whatever price we choose, just as much as we are free to shop around as buyers for the best deal. You need to fill up your car with gas. Feel free to drive all over town comparing gas prices and fill up where you choose. Caveat emptor all day long, right? Wrong. In 2010, our beloved government created a new rule for the mortgage industry to protect its citizens from getting screwed when getting a mortgage. In short, the rule stated the compensation that an LO receives cannot vary based on the terms of the loan. That means there is no longer an incentive for loan officers to sell a client a higher rate because they will only make their flat commission. No more overages to be shared. Remember this point, as it'll mean more in a minute. Sounds reasonable, doesn't it? I mean, I have been a mortgage broker for over 2 decades, and even I am in favor of this rule because it protects the interests of my clients. The only problem with this rule is that it doesn't apply to banks. That's right. Loan officers and mortgage brokers are all limited in what they can earn on a loan, but our good old government saw to it that the banks can still make the backside pricing, and even worse, they no longer have to share it with their LOs. And I'm wondering, okay, that's the gist of the article here. So there's obviously a lot of stuff in the mortgage industry that people don't talk about. And I think a lot of that is a derivative of people want to feel like it's like getting a car loan, right? You go into the bank or the credit union when you get a car loan, and they say, yeah, we'll give you 5 years at this interest rate. Here's your payment. And, it's the same bank you have your checking account at. It's there the whole time. They hold the title to your car, whatever. It's pretty simple. Mortgages don't really work that way. And that's because of mortgage-backed securities. This thing's going to get priced up, repackaged, sold on the secondary market to investors that are going to buy this bond now. So from a pricing standpoint, the back end makes sense. But give me more context on, is this legit in the industry? Does this still happen? And can banks really and loan officers at banks do it differently than like this article is written by a broker that's trying to highlight, it's his people get fair pricing or whatever.
Yeah. Let me give you some context when I started. When I started in the business, I got licensed December of 2007. Interesting time to be getting in, right? Within months of things starting to crumble. Mm-hmm. At that time, the compensation that company was offering was a percentage of the total fee income that the loan officer would bring into the company. So,
which is a pretty standard, like in any industry, that would be a normal way to do commissions. Okay.
So some of the things to kind of peel back that the more total fee income you brought, your percentage would increase. So top producers were making a lot more than the guys that are closing 1 or 2 deals a month.
Okay.
The problem with that one is government insured loan products, banks will make a larger margin. They make more money when they sell them.
It's because it's an insured product. It's safe. It essentially artificially boosts the credit rating on the mortgage-backed security when it sells on the secondary market.
Which makes sense, but you just incentivized a loan officer to say, I can make more money by encouraging my clients to do an FHA loan or a VA loan or an RDA loan over a standard conventional loan, strictly because they can make more money. And sometimes you put those products side by side, and you could kind of put a little sales pitch together on why one would be better than the other. But when you put a little emphasis and put that FHA loan in front of them, it was self-serving.
Sure.
So I see the regulation being good. It keeps loan officers a little bit more honest, but the concepts are still the same. Banks will make more money. Mortgage companies will make more money at a higher interest rate. It just means that the LO can't be comped anymore. Mm-hmm. But we can still turn around and give it as a lender credit to the consumer. So it's still a tool. It's still out there. It's still a legit real thing. But that regulation, the part and he highlights this in the article, mortgage loan officers, mortgage companies, mortgage brokers are heavily regulated with their comp, but credit unions and banks don't have the same regulations.
So important distinction, because there's in the mortgage world, there's brokers, which are a shop that just has a contract set up with multiple banks, more or less, to write whatever their current offerings or products are. But they use the underwriters at the different banks. Then there's banks like the public generally thinks about it, like the Wells Fargos, the Chase banks, even maybe your regional banks, right? That you're going to walk into realistically what the depository institutions are, right? And then there's the mortgage bank in the middle where they're using their own money to fund loans, right? But then they're selling them off to the secondary market. So it's not a depository institution, but it's still technically a bank, right?
In general, yes.
In general, yes.
Yes, that's the general three big ones.
Yeah.
Yeah.
Okay, so when you're saying banks and that their banks and credit unions are not regulated the same way in the way that the LOs are.
Let me clarify that. It's like, when I say that, I'm usually referring to a retail outlet. Mm-hmm. Someone goes into their local credit union, they sit down with the loan officer there, bank or credit union. That's kind of your retail side, your face-to-face retail. Give you a prime example. This has been a number of years back. I ended up doing 2 loans right close to each other for Wells Fargo employees.
Okay. The
Wells Fargo employee, who is a teller doing consumer loans, went to Wells Fargo thinking, well, I'm an employee, I should get a really good deal. Mm-hmm. And they came and met with me because they just felt like it wasn't quite as good of a deal as they should get as an employee.
Yeah.
Well, I turned around and on my rate sheet, I was pulling Wells Fargo's rates that we intended to originate the loan and sell it to an investor. We would refer to Wells Fargo as one of our investors, one of the banks that we sell to. And I was able to get my full normal margin without discount and give that employee a better deal than they got with Wells Fargo directly as an employee. Right? So I'm just saying Wells Fargo is playing in every arena. They're playing in the retail market. They're dealing with as the investor in the secondary market. They've got their hands in every pot.
Okay.
So
if we're trying to educate the public about being a savvy, consumer and being able to, be a better buyer, if you will, right? Are they going to get a different rate going to a broker versus a mortgage bank versus a retail outlet?
I'd love to get Sean's take.
This topic is interesting just because the answer is yes and no. So any rate at any time is available to a consumer. Uh-huh. Okay. So you can go right now, say the average rate's like 7%, right? In general, right? Don't quote me on that APR. I'm not quoting a rate right now, but in general, say it's a 7% is being offered. That rate you can get at Wells Fargo. If you walk into Wells Fargo, you can get that rate. If you walk into a credit union, you can call a mortgage broker, you can get that rate, or you can call like a retail lender, like where I work, and get a 7%. The difference is going to be the cost to get that interest rate, if there is a cost. So I think the biggest thing for a consumer, just to like simplify it, is at any time you can get any rate. It's just what's that going to cost, or on the flip side, is there even going to be a cost? Because when refinances were popular, the term no cost refinancing was, hey, well, I got a letter in the mail. It's not going to cost me anything to refinance. And that's technically not true. What they're doing to kind of, highlight what Ben was saying is they're just going with a little higher interest rate to offset having to charge an origination or a discount point.
So they're taking what the overage used to be, basically, right, and applying it towards the cost, the hard cost of originating the loan, so that the consumer doesn't have to pay the hard cost. So they're passing through what they used to keep as a commission, right? And the consumer can benefit from that, but it's not truly free. You could have gotten, if you looked at the rates in a savvy manner, you might have actually been able to get a lower rate. So you could have paid a cost, but got a better rate, which may or may not be beneficial.
Right. Yeah. And then that just goes into the whole overview of like, is it worth buying points? Right. And that's like a whole discussion we could have too. Is the lower rate more important, or is it better benefit them financially?
I would love to have that conversation. So, I don't know everything about mortgages. I'm not a mortgage lender. But I know how bonds work and are priced. So when I bought my mortgage, I got my mortgage, a couple of years back. I'd gotten I was approved at a 3.5, and a couple of days before closing, I was just telling Ben about this on the car right over here. Talked to him a couple of days before closing, and I could go from a 3.5 to 3.65, an extra eighth. And I got just over $9,000 lender credit that I then used to apply towards my closing costs of originating the loan and my other costs associated with the purchase. Right. And that was on a VA loan. So I bought my house literally $0 at closing. Right. It was awesome. And then I did end up refinancing a couple months later, and it turned out great. But what does that look like if somebody goes, because now we're in a way different environment than we were in 2019. So points, because there's all this stuff out there about, you're buying a home and the builder will give you a credit or a rate buy down and leave that. But it's just a cost. So if you want, how is that priced?
Just moving the numbers around, right? I'll give you an example. 2022 and earlier into my career, it was very common to hear the word premium price. Premium price means there's no origination charges or discount, no points being charged. In fact, we're quoting an interest rate a little bit higher to help give that credit back to the consumer. So we'd premium price a loan, trying to make it really economical on the closing cost side. Maybe I'm going to deviate from answering your question with kind of giving a little bit of an analogy. I tell a lot of my clients that I'm going to give you a menu of options, a menu of interest rates, and a menu of the associated closing costs that go with it.
Yeah.
But picture it like a teeter-totter. Interest rates on one side, closing costs are on the other. And as you apply pressure on one side of the teeter-totter, the other one's going to naturally come up. Mm-hmm. So it really comes down to, where do you think the market is going? Because if hindsight's 2020, if we knew exactly what the market was going to be doing in 6 months, a year, 2 years, 3 years down the road, we'd be able to package a perfect economical scenario on a loan. But I have found the majority of my career, I have premium priced because let the market give you your discounts, right? Rather than paying for it. So that's the way I've always operated, is on the teeter-totter, I'm always looking at keeping the costs low and then explaining and showing the numbers on the rate.
Yeah.
Am I making sense when I picture it that way?
Yeah. For me, yeah. So for me, in my case, I felt like I'd rather have a 3.65, which is a little bit higher rate, an extra eighth of a point. But
here's where your consumer problem is. Loan officers aren't giving the options. They're not showing the menu. They're not saying, here's 4 or 5 different interest rates with the associated cost. They're quoting one interest rate with what they think is the best for the consumer. That's where I feel like the biggest gap in the industry is. Sean, what's your take on it?
Yeah, that's what I was going to say is, as a consumer, if someone's like watching this, I wouldn't necessarily, I would definitely recommend using like a mortgage expert, someone that's been doing it for a long time. I probably wouldn't recommend a credit union or a bank, just more so, especially on a purchase, the most important thing is getting the house and closing on time. And so with big banks and even with brokers, sometimes because they're not fulfilling the loan in-house, they're giving away that control. So I would, if a consumer's like, when they get so focused on rate and cost, I think sometimes they lose focus of what's the most important, because a mortgage company doesn't have to, if they give you a quote up front, they get a loan estimate and it's not locked, they can quote anything all day. They don't have to guarantee and fulfill that at the end. So that's another kind of common myth.
Yeah.
There's nothing holding that mortgage company responsible for honoring what they, quoted to win the deal up front. So as a consumer, definitely focus on prioritizing, hey, who's going to guarantee or who's going to help me get the home? Because that's the most important thing, right? How do I secure the asset, essentially? And then from there, like Ben's saying, is if the loan officer's not already doing it, that might be a red flag, but getting options within the same day pricing, because a lot of times consumers don't realize too, it's like tomorrow the market might be different and rates might be different. So
it could be different later this afternoon.
It could be, intraday pricing could change. So But to simplify it, get the different options. And then between the different options, it's, hey, what's the interest rate? What does my payment look like? And then what's the cost involved?
And find your break even.
And then from there, it's, hey, because I'm going to have this loan for X amount of time, depending on the client's goals, are they going to be in the home 3 years, 5 years, 10 years? It's more of like almost like a financial planning question, and like doing a deep dive on, hey, what's the family's goals with the home, with the asset? And then from there, it's, hey, which one meets that goal best? And it doesn't make sense to pay $10,000 more at closing.
But what you're describing right there is finding a loan officer that wants to build a relationship with you and map out a plan for not only this transaction, but your future, right?
100%. Yeah.
And not transactional. And
yeah,
how many loan officers that work for credit unions, banks, or even mortgage companies, most of them are transactional.
Well, I'm not a mortgage loan officer, and I have these conversations with clients as a financial planner. When I have clients that are savvy enough to remember to call ahead of decisions like this, let's talk through this. And we try to map out exactly what you said, Sean, which is, how long are you realistically going to live here? Because an investment property is an entirely different conversation than getting a larger primary residence because kids are growing up, right? And then the future downsize plays into that, and whatever somebody's goals are. But mapping out how long you're going to own the home for. I think simplified down, what you're saying is, and I don't know what the pricing on the back end looks like right now in the market exactly, but if you're going to originate a loan and to have it go from as an example, like a 7% interest rate to a 6% interest rate, because for whatever reason you feel like emotionally that's what you need to have, and that's going to cost $30,000, right? Like it's going to be an expensive buy down.
Yeah.
But you're saying, well, the seller was going to give me a credit, so they're going to pay for it. So I don't have to pull like $30,000 out of my checking account. It's just going to be a credit that's going to be applied. The bank will get that $30,000 basically, and that offsets them having basically a subpar bond now that they have to try to sell. And all you're saying is, look at that $30,000. If the difference in the 1% of the interest rate is going to save you $10,000 in interest over the next 5 years you intend to have the home, don't spend $30,000 to save $10,000.
Mm-hmm. Stepping over a dollar to pick up a dime.
It's just that. It is that simple, right? You just, when you break down the math, am I missing a part of that conversation?
Simplified, yes. Yeah.
So let me add to that. I feel like with consumers, a conversation I have on the regular basis is there's two types of capital we want to talk about: financial capital and emotional capital. Sometimes we have those emotional decision makers that can't get past the rate. They have to have it at a very specific rate to feel comfortable with the payment. Mm-hmm. They are willing to spend the financial capital to keep their emotional capital reservoir filled. And to me, I think it's important as a loan officer to understand that with the clients that we're working with, because it's not all financial. I wish all of us were analytical and it all came down to the numbers. It would be a lot easier to present them and the decisions would be made quicker and easier. But most people are heavily driven on the emotional side. So to me, I think it's Sean and I's job as originators to educate and due to the education piece, explain the numbers, and they will make a better decision for them and their family. Mm-hmm. But we still have to consider the emotional side.
Yeah. So in your example, the 30,000, it's tough to say yes or no or like advise on that because the seller's covering the credit. So they're not technically incurring the cost. In the simple math though, yeah, if they're not going to make back 30,000 and they're going to sell the home within that time frame, it's lost funds. They might as well just do a discount on the purchase price. Yeah,
exactly. So just because you're not coming out of pocket per se, it's all part of a broader negotiation in the real estate transaction.
Yeah, it's assuming that it can be negotiated. Think of how many builders out there that will offer a massive credit, but they're not going to come down in price because that's going to hurt them comp in the subdivision that they're actively building in.
Yeah, if they put it on the MLS.
So there's just so many scenarios that they're all individual.
Yeah. So for a client, so say they're going to incur the cost themselves and they're going to pay to buy a point down or 2 points. And they're like, hey, does it make sense to get that lower payment? Because emotionally, it might feel like, oh yeah, hey, I'm getting a 6%, or it's $200 lower per month in payment. But what we would want to do is do an analysis and say, hey, today at 7.25, you don't have to pay any costs, hard costs. And then say at like 6%, you're paying 10,000, right? Or whatever. And then we can look at the amortization schedule, run the numbers at 3 or 5 or 10 years and say, hey, your break even point on your costs over your payment savings per month, say you're saving $200 a month, it's going to cost 10,000. Your break even point is going to be 50 months. So if you're going to remain in the home for 50 months, you're going to recoup the savings. That probably is a smart investment. But right now, which is interesting, is we're in a we could be in a possibly lower interest rate trending environment. So in 12 to 18 months, based on the Fed's policy, right? The Fed funds rate could technically be lower in 2025.
I think you're so wrong, but keep digging.
So the Fed's outlook, if we were to pull it up, it is supposed to be lower based on their forecast.
Based on the dot plot?
Yes.
Okay.
So assuming that comes to fruition, right? I'm not advising this. I'm just saying based on what they've forecasted, in 12 to 24 months, rates could be lower. Okay. So if someone were to buy down, they might refinance in 12 to 24 months, which could affect their recoupment decision, right? And like, hey, well, if I'm going to be in the home for 5 years for sure, and I might refinance in 2 years, do I still pay the costs for 5 years? Right. So it's not a guarantee, and we don't advise people to say, hey, yeah, there's a guaranteed refinance opportunity, so don't buy down points for 5 years. It's up to the individual. But what's interesting about where we're at right now with interest rates is there could be that event.
But that's what I'm saying. Hindsight's 2020. It would be easier for us to work it backwards and say, hey, here's the best way to structure that economically, right? But we just don't know the variables. We don't know what's going to happen with house prices. We don't know what's going to happen with interest rates. There's just too many variables. And I come back to the part that I was talking about earlier, financial capital and emotional capital. It is my job as a loan officer to kind of assess the consumer and say, which are they? Are they going to make their decision off of the analytical side of their brain or the emotional side, and try to help them navigate that? I'm not there to tell them what to do. I'm there to lay out the facts, the options, the different loan structures, and help them make the best decision for them and their family.
Yeah, because some clients, they would rather have a lower payment, and maybe they're selling a house and have a ton of equity, and they're okay with, saying, hey, if I do refinance in 2 years and I pay a big upfront cost to buy down, I'm okay if I lose the money. But, this is a 30-year loan. This is our forever home. I would just rather have the lower payment. So for some clients, it's like, it really just depends on their situation. But, for some clients, there's kind of two groups I'm seeing right now. The client that really is payment focused and like they really need the payment lower. And then the client that's, hey, this is kind of my forever home. I'm not really payment focused. I'm okay with, my payment being higher and then doing a refi down the road. So it's individual. And it really does help to have an expert loan officer walk you through that too, to kind of see, hey, which one is going to be best based on your long-term financial goals with the home. Yeah,
I think it's a good way to frame that. I want to go back to the article though, because one of your questions earlier was how does someone become a more savvy consumer when going into shopping for a mortgage? Understanding the company and how they work and operate, I think is pretty critical. And the expertise that go behind it. We could all find our way to the airport. We could take a limousine and be chauffeured. We could also hitchhike. We could get to the same end destination and have a completely different experience. And I think mortgage companies are just that. Not every loan officer has the same expertise, knows how to kind of navigate that and eliminate as much of the turbulence as you possibly can. And sometimes you might pay a little bit for that improved experience. So also understanding not only how long the loan officer's been in the business and how well they know their craft, also understanding their comp structure. You got some companies out there that pay kind of a base salary, and then they pay a smaller amount of commission or bips. Then you have others that are 100% commission. So some are kind of transactional with a call center model versus the relationship base that you're going to be looking in the eyes of that person at in the aisle of Costco someday, right?
Yeah.
They're just understanding those dynamics and who do you want to work with, the type of person that's going to treat it like a relationship that you're going to use over and over again as a consultant, or someone that's going to be transactional. Because I'll tell you what, you can probably call enough mortgage companies, both online call centers, credit unions, banks, brokers, and find someone that will do it really cheap. But I would never hitchhike to the airport. So.
And why not? Why wouldn't you hitchhike?
Because I'm burning the emotional capital as I'm saving financial capital. So
he's worried he's too cute. He's gonna.
What's that?
So you're too cute, he said. But what if you don't make it to the airplane in time?
Yeah, you're missing. If it's a purchase transaction, you're not performing. So you're losing out on the house. You're losing your earnest money. There's a lot at stake, right?
So they're intangible costs. Yeah. I think of it kind of like tax planning, like dealing with maybe a high quality mortgage professional that isn't, you know what I mean? You haven't gotten somebody to shave all the costs off because they respect themselves as professionals and they want to get, they need to make a living too. And that's okay. There's nothing wrong with that. But in tax planning, one of the things that you always have a hard time with is the value is harder to see sometimes because it's not in the form of a dollar amount in an account going up. It's just in dollars that you've helped somebody avoid paying, right? You've helped you navigate a situation to avoid pain and costs and stuff. And there's a cost of working with someone like me that does tax planning. But a good mortgage professional is going to help you navigate the interest rate decisions. They should be able to help you understand the cost. What is a good decision, laying it out, right? They should be able to walk you through that. And the cost that they may be helping you save is in losing out on the house and having to continue to waste your own time and emotional capital looking for another house again now, or protecting earnest money that you have at risk, or all these other conditions. Those things can be really painful if they come to fruition, just like if you have a blunder on your tax planning and you end up having to pay a bunch of money in taxes.
And sometimes those blunders can be huge. So, yes. I'll give you an example. Earlier in my career, I had this younger couple referred to me. They had a little townhome condo that they were in the process of refinancing with a local credit union. Their friend encouraged them to get a second opinion. They came down and sat down with me. I maybe spent 15 minutes with them. And those first few minutes of the conversation is getting to understand exactly what Sean talked about earlier. Understand what are their goals? Where do they plan to be in 2 or 3 years from now? Mm-hmm. Well, right out of the gate, he was finishing his undergrad and they were going to be moving across country and plan to sell that house. So here I'm looking at the estimate that the credit union's prepared for him, paying about 1.5 in origination fees. I'm doing the break even real quick off of that estimate, not even the estimate that I've prepared. Mm-hmm. I'm going, man, you're 4 or 5 years before you even break even. So we ended the conversation right there and said, no, you shouldn't be refinancing at all. If you're going to sell this thing in 2 years, just keep the same interest rate where you're at. If you want to save yourself in some interest, throw a little extra principal at it, and not do it. I told that person no. I could have taken advantage of them. I could have put a deal together where the cost was a little lower, the interest rate was a little lower, and closed a mortgage. But she ended up being one of my top referral partners because she is a hairdresser, does hair for a living. Her job, a big portion of her job is to small talk with her clients while they're doing hair, right? So I ended up doing 3 or 4 transactions that next year from people that she referred over, because we consulted the right way, right? We became the consultant, not the transactional guy. So I just use that as an example of how important as a consumer to align yourself with the right people that are going to give you good advice.
I think that's probably the best.
That was great. Yeah,
that's probably
that.
That's
awesome.
that's the real. I mean, I think that's always the real trick, right? Is finding people that care about a relationship with you more so than a transaction, which is tough because I always say this, right? Like, when I first started and people say like, well, so what's your, mission statement, right? When I got into financial planning stuff, like we want to help people, and people are always like, yeah, great. And the more I thought about it, the more I stayed on it. I'm like, that is our true intention. But that's like, everyone says that. You can be, a fast food restaurant and be like, our job is to uplift people's days, and help people. And it's like, because who is going to have their mission statement be like, I'm here to screw people and make money for myself, right? No one's going to say that out loud. So everyone is going to say, oh, I'm not transactional. I care about a relationship. I want to have, this isn't just about making a sale for me. This is about so much more. I want a long-term relationship with you guys, and I want, blah, blah, blah. And it's a sales pitch that will come out of everyone's mouth.
Totally agree.
So you have to find the person that genuinely has built a business or a reputation on the relationships really do matter to them. They have some kind of component to their business model that like it makes a difference, right? And then you have to also find somebody that has the skill and competency to be worth having a relationship with too, right? Somebody can be a really great guy, right? Doesn't mean you necessarily also want to work with them.
Yeah. I actually compare mortgage. It's a weird comparison, but an auto mechanic and a mortgage loan officer.
Okay.
I know nothing about cars. I could go to a mechanic and they could tell me all these things that are wrong with my car. I don't have the ability to verify.
Your mechanic just got a raise.
Yes, he did. So I have to go to mechanics that have a good reputation that other people can vouch for and go, yeah, Mr. Mechanic down the road treated me good. And I've got 2 or 3 endorsements from people that say, yeah, he does it and does the right thing for the right reasons.
Mm-hmm.
Because I don't know any better, right? And I think with mortgages, it's tough too, that people have to kind of treat that same. How many mortgages do people get in a lifetime? How informed are they?
I don't know. Is there a study that you know about? Like I would actually think it's probably between 6 and 10. I don't know. Do you know the stat?
Well, the one stat is the average homeowner moves every 5 to 7 years. So assuming they get one mortgage every 5 to 7 years, you could probably do like a rough, I think 10 is probably fair, but if they refinance, sure, that's another number.
But then what's the average? People who have a second home, cabin, rental property, like it could be a much larger number for some. And then there's others that never get a mortgage until they're in their 50s or 60s, right? They rent the majority of their life.
My parents got one mortgage ever.
Ever.
Wow.
I lost my train of thought. What I was going to share with that. Scratch it.
Scratch it all from the record.
To tie it into financial planning is like, if you go and you're going to give someone some money, if they don't sit down with you and really understand your goals, your long-term planning, understand your income, understand your potential income earning over the lifetime. Do you have a spouse? Are you planning on having kids? Going through your debt, like really doing a deep dive. What is your financial goals? Like, can you have multiple financial goals, right? What financial products do you have? Like if someone's not going to take the time to ask you those questions, and then all of a sudden they're recommending a product to you, that could be a red flag. And I would relate that to mortgages too. Like your mortgage is one of your biggest debts, but possibly one of your biggest assets, And so if that loan officer or mortgage consultant's not doing a deep dive on your goals, then how can they recommend you a product? Like it's always fun for me when someone calls, hey, give me your best rate. And it's like, I don't even know anything about your situation. Like, and then not to mention to even quote you, I've got, 10 different things I got to ask you, right? Like lock term, credit, down payment, like loan product,
loan type. Yeah.
So there's so many things that I can't, and go back to like, to truly help. I can't really help that client until I really understand them and know their individual situation.
It's no different than when people come up to me on the street and say like, what stock should I be buying right now?
Yeah.
Like as if I'm Motley Fool or something, like, that's a really good point. and mortgage is complex. I think talking about the endorsements of professionals you're considering working with, being a savvy consumer. One of the things that I've really started to lean into and look for, as I've learned in, especially like in our area here in Southern Utah, like there's a lot of people that have friends or know somebody that works in an industry, right? And somebody can be someone's friend and be a really great person. And that doesn't make them the right professional for you or even good at what they do. Right. And somebody could have had a good experience, but what was the experience? Right. Because they could have felt good, but you could feel good while you're getting absolutely screwed, candidly. Right. It's so, like, what was the experience? And then has somebody like, what was the outcome? And have you worked with, so like the questions I like ask, have you worked with them? Like, what have you observed, right? Like, okay, so you know them and you like them. Where does this trust come from? Can you give me, like, help me understand? So if somebody's never had the auto mechanic fix their car, but they say, look, I've known him for years, and every time I've ever, needed something, I know this guy personally, and I just call him. He's the kind of guy that shows up. That might hold weight, right? But then you still probably want to go find out, like, does he know how to work on cars?
Yeah.
Right? Because that's also very important to your situation. You're not needing help unloading groceries. You're needing help fixing a transmission. He's got to have the soft skill, the integrity, right? The long-term vision. He also needs a technical skill.
One of the questions I like to ask is
he or she.
What problem did this individual help you solve? Mm-hmm. And it gives context. Like, was it something fairly simple, or how complex? There's a lot of loan officers in our industry that are not confident with self-employed tax returns, and they kind of paralyze. Right? They get paralyzed on it. I find a lot of referrals that I receive are people who have a little bit more of a complicated financial situation. There's a term that we use in the office quite a bit. This consumer is going to be kind of irritated by the amount of things we're going to ask for, but it's because they got a lot of good things going on in their financial situation, right? If you own 10 properties, I need 10 mortgage statements if they're mortgaged. Mm-hmm. That list can start getting kind of extensive, but it's you got a lot of good things going on in your financial portfolio. So
a good wealth manager that specializes in the niche of real estate might have hopefully coached somebody into having that stuff organized into loan packets ahead of time.
That'd be awesome. Only if I knew a guy. Want to go back to the original question of savvy consumer. I want to highlight here on the podcast that mortgage companies make money in two ways. They make monies on some of the fees that are being charged on the settlement statement at the time of closing, completely transparent. Their fees that were initially disclosed up front and charged at the end. Mm-hmm. And then they will make money when they turn around and sell that loan to an investor after the fact. So knowing that there's those two ways of making money. So a consumer should be looking at two things, right? Mm-hmm. Closing costs, what's the actual fees from origination and all the fixed cost, side by side if they're looking at multiple lenders. And then two, each mortgage company, even though you may call 10 of them and get 10 quotes with the exact same scenario, I'm willing to say that 8 out of those 10 are probably going to come within 0.25% of each other on a range of rates. Mm-hmm. You might have 1 or 2 that are outliers. And just like if you're doing a remodel, if you got a bunch of plumbing quotes, you probably shouldn't go with the lowest quote. You're probably going to inherit some other problems.
Some real crappy problems.
Yeah, no pun intended. Same thing with the mortgage side, but I think you're going to find most quotes coming kind of in a pack within probably 0.25% range. You want to weigh in on that?
I'd say, yeah, it's general.
Pretty close. But what you're going to find is the mortgage companies out there are going to set their margins on how much money they want to make because they're going to turn around and sell it in the secondary market. Mm-hmm. So understanding that kind of the mechanic side of that help you to ask better questions, and you'll find certain mortgage companies that just will always price out a little bit higher than their competition. But their clientele isn't the one that's focusing on rate. They're focusing on another aspect of the transaction. Maybe it's closing on time, right? Maybe it's that concierge service of the limousine ride to the airport.
They have a different unique value proposition.
But my point is, doesn't hurt to ask.
Yeah.
Just because a company has a margin doesn't mean that they can't go and ask for an exception to have either fees reduced or a slightly lower interest rate. It never hurts to ask and be told no.
I think it's a valid enough conversation to talk about how that bond is, or that is sort of priced. Like the mortgage is priced and sold, and they make money on the backside of that, and how that sort of works. People forget when you think about banks and what's an asset and what's a liability, right? So if you own a home, it's an asset, and if you have a mortgage, it's a liability, right? Banks, you flip what's an asset and what's a liability, right? So when you put money into the bank in your savings account, that's not an asset for the bank. It's a liability, because to them, it's a loan. They've borrowed that money from you. To them, a deposit is a debt. So when they loan money, right, that becomes an asset for them
on
because now you owe them money, right? Mm-hmm. So when a mortgage company originates a loan, it's now an asset on their books. It's not a liability like it is to you, right? And so when they sell that loan, it's not because there's some goofy thing that's, sleight of hand, dirty thing going on. It's that it's an asset. It's inventory. It's just like any other business that if the business has inventory, it's an asset, and they want to sell it to somebody, and they're going to generate some revenue by, gathering that asset cheaper than they can sell it for, right? That's the context of basically every business, right? So what a mortgage bank essentially has to do, from my understanding, they have to get you to agree to borrow money at a certain rate that is more attractive than what the general, market is necessarily paying on the secondary market. So that way they can issue the debt and then package it with maybe a handful of other loans they've also originated, right? A bunch of assets now, and they sell that off to somebody that's going to create a mortgage-backed security that will then trade most likely on the market, right? In the bond market. Shows up in people's 401ks now, That's how it gets there. There's nothing good, bad, right, or wrong about that. And to give the people that think banks just always screw everyone a little bit of comfort, all the banks that bought those mortgages in 2021 have taken a bath on them because they went down so far in value as the interest rates came up. So part of this is that it's not that the consumer is ever like getting screwed inherently. It's that there's risk to whoever's, somebody's borrowed you hundreds of thousands of dollars on a 30-year fixed term. There is a ton of duration risk that whoever ends up with that they have to carry that. So at some point in the process, in the fluctuations, someone's going to be making some money. Then that's just how it works.
Yeah. I'd like to explain even a little bit, explain how a mortgage goes from origination to kind of the end destination. When someone comes in and takes a loan application with me, we are originating it. We are creating it. It didn't exist before we took an application and started.
Going to manufacture it.
Right? To manufacture it. So we originate it. The company I work for and the company that Sean works for, we're referred to as mortgage bankers, which means we are going to fund the loan, right? It's going to be an asset to the company that when we fund it.
Yep.
But for let's just use easy numbers. Let's say that we had $10 million worth of capital as a company, and our average loan amount is $500,000. How many loans could we do before we run out of money?
Yeah, 20 loans.
20 loans. Within a couple months of doing business, we're tapped. So we need to turn around and sell those loans off to the secondary market to replenish our cash to continue to originate. Now, once we do have a loan in place and we turn around and sell it, there's really two pieces of a loan. There's the promissory note, which is the contract to pay, and servicing rights. So let's just use an example of Chase Bank. Chase Bank purchases the loan that we funded. They break that into two. They retain the servicing rights, and then they turn around and sell the promissory note to Fannie Mae or Freddie Mac, right? That is where Fannie Mae and Freddie Mac will bundle hundreds, if not thousands, of loans that are very similar in interest rate, credit scores, and they create a mortgage-backed security that is then sold on Wall Street. So that kind of maps out from origination to end destination. And when we quote interest rates, our rates can fluctuate a little bit, and sometimes we'll find a sweet spot based off of how things are being sold on Wall Street with mortgage-backed securities. There might be a heavier demand at one particular rate, so we might be compensated or get a little bit better pricing. I shouldn't say compensated. We get better pricing at a particular rate because there's a demand that the mortgage-backed securities are putting on that particular coupon. Does that make sense?
Yeah. Well, and there's a deeper conversation to be had on how the portfolio managers essentially build those, if you will, because of the duration risk that some loans carry relative to others. So coupon and the yield to maturity are huge numbers that all factor in, and it's all relative to what else is on the market and how is it trading right now. So there might be that demand that you're talking about might be relative because they're saying like we can take more of that risk in this and in these sets of bonds in the current market conditions to kind of round things out.
Yeah, and I know my understanding on that side of the fence is very, very limited. I just know that when I pull a rate sheet, it's not always incremental. Yeah, like okay, if we go lower in rate,
it's not linear.
The cost should be going up a similar portion, but sometimes you'll find like, oh man, it's weird. We're getting a really good sweet spot. It doesn't cost that much to buy down to this rate, but an eighth above or an eighth below, completely different, right? Mm-hmm. So we'll find a sweet spot. I found a sweet spot on an FHA deal just a couple weeks ago that I was baffled at how low we could get that rate for a minimal cost. But it was just that one particular rate above or below. The numbers didn't pencil.
Does that vary by like credit rating and other demographics factors of the loan? Like at that time, like it's really not just about the rate. It's about the profile of the
entire profile
loan.
Yep. Mm-hmm. Yep.
Yeah.
I tried to explain that in simpler terms on how that moves. It's obviously there's more moving parts and it's way more complicated, but I think from a general overview, I did a pretty good explanation. What would you add to that?
Yeah. Like I would just say I geek out on that stuff. Like when I'm going to lock an interest rate, just because in looking out for the client's best interest, it might be like a 6.25 might be pricing out at a point, but a 6.125 might be 0.9%. And so the math on the savings, I just geek out on all those numbers. And so it's just wise. I think it's more like loan officer advice to just look at the rate sheet in its entirety and say, hey, what bond or what rate is pricing better? Because you might be able to
package it
like
better.
A rate, a higher rate might be actually costing more than a lower rate.
Mm-hmm.
Yeah.
Or the savings might make more sense to just go a little bit lower.
Yeah.
For whatever reason. I think the demand on the secondary market probably.
On Wall Street, remember that. But, mortgages, they don't price in a way on the market that people are going to hold them for 30 years. Right. And so they have to sort of look at it and say, okay, if Johnny buys down to Johnny doesn't buy down to a 6.25% rate and all the other rates are under, a normal rate right now is only 6 or 6.5 or whatever, right? Johnny's going to say, yeah, I'll take all this extra money up front and I'll sign me up for an 8%er. They're like, he's going to refinance in 6 months. And now we've paid a premium to get that bond on the books, paid all the fees to get, the different institutional bankers and all this stuff, right? To package this whole thing. And then he came along a year later and paid it off. Because remember, he didn't pay off his mortgage. He refinanced into a new mortgage. And so the new mortgage paid off the old mortgage. So to the bond that gets added to, it's an early prepayment.
Yeah.
Which is not good if you're trying to buy a stream of cash flows as the bond investor that somebody comes and says, they have your money back. I'm not paying the payments anymore. What you wanted was a stream of cash flows.
Which goes to explain, can I add something to that there?
Yeah.
On occasion, it doesn't happen terribly often. It did earlier in my career. You get people that would call and complain that, my mortgage got transferred again. PennyMac sold it to Mr. Cooper, or Mr. Cooper sold it to AmeriHome or whatever.
Yeah.
And they get irritated that every time it gets transferred, which is being, bought and sold in the secondary market, but banks are rebalancing their portfolio. They want to balance having to do with those cash flows. Sometimes they want loans that help are securitized a little bit better with stronger loan to values. Some are focusing on rates that they're not at risk of having those, refinanced and taken off their books. Mm-hmm. So to explain to any listeners that are wondering why their loans are bought and sold, it's really a rebalancing side of the banks behind the scenes. Mm-hmm. So just some context.
We see that all the time with insurance companies in their underwriting of different cases. So you can see like an insurance company. So just to put it in sort of a different light, but the same concept, you can see one insurance company that you could take somebody with diabetes and get a quote for them today for like life insurance. And the company A made like the cost would be super high. And, maybe company B is all, moderate. You find whatever, you quote out 10 different companies and you can go back 6 months later, maybe, or a year later, and company A that had priced themselves wildly out of the market for the same individual, the same underwriting, could come back and be the most competitive on price. And it's because they're looking at their book and the risk that they're carrying, and they're saying, we have too many diabetics. We don't want more diabetics right now. And then all of a sudden, no diabetics sign up, and some people cancel policies, and some people die, and some people, whatever. And all of a sudden they're going, man, we don't really have any diabetics, so we could take on that risk and charge a good premium for having that risk. So let's price ourselves back into the market on that to attract the risk. We'll kind of fill up, and then we'll reprice and adjust. It happens all the time in insurance companies, the same way.
Banking, even just with your normal credit cards, automobiles, you usually get these little teaser rates on products. Mm-hmm. It's because they're trying to generate a loan to fill a certain portion of the segment. They want more loans in that category. And then when they hit that quota, all of a sudden the teaser rates and incentives go away. So
it's all gone. Really quick, we've talked about points a number of times. Is it fair to define what a point is? I don't think most people know what a point or a BIP is. We all do.
I default to Sean. Sean's good at explaining this.
So, do you have does he have like a special explanation on what a point is?
Great elevator pitch. Let's time it.
I was going to, okay.
So the question's, what is a mortgage point, or
just what's a point? Just
point, discount point.
Yeah. So when mortgage lenders are saying, oh, that's going to cost you a point, or I make 2 points on this loan, or that's going to be 35 bips. What do those things mean?
Yeah,
because it's a foreign language. People don't know.
Yeah,
most people don't speak banker.
Yeah. So point is just a percentage of the loan amount.
It's a percentage point,
which is usually referred to as the cost associated, right? Mm-hmm. When we're referring to points, it's usually the cost to buy down into the percentage of the loan amount.
Right. So if I said, hey Ben, you quoted me, you had given me an option of a 6.5%. What does it cost to go to a 6%? And I'm on this, let's call it a $500,000 loan. And you say it's going to be 1 point.
Yeah. 1% of your loan amount. So if we're talking about
$5,000.
$5,000. Yep.
And what's funny with that is some companies say, and I won't drop any names, but there's a major credit union here in the area that's notorious for saying we don't charge any points, right? So then you think, oh, hey, well, if this other company that I'm comparing to they're charging a point and this company's not, I'm getting a deal, I'm going with them, right? But mortgage companies can also disguise it in what's called origination fees.
Yeah.
So an origination fee is a percentage-based charge as well, typically determined by interest rate. But because it's not called a discount point, they can sound more competitive. So there is ways if you're comparing, and that's why it's good to look at the total cost rather than just saying, hey, are you charging a point on the same rate?
Try to take the emotion out of it. It doesn't matter where you're paying the money. You're paying the money either way.
Well, and that's what I hate about mortgage. Every mortgage company does it different, right? Some they itemize it all out. So there's a processing fee, underwriting fee, doc prep fee, credit report fee, appraisal fee, and they do it all. And then you have someone else that will go, nah, all lender fees are going to be lumped into one line item. Why break them all out, right? So here's a flat rate fee of $1,500. It doesn't matter how you polish it up.
Yeah.
It's what is the total number when you add them all together? Because I've had clients go, well, this company over here has a $1,000 lower processing fee. I need you to match it. I'm like, yeah, but my underwriting fee is $300 lower. I'm already net negative. Like, you want me to match that one? You know, I consumers just usually don't know how to subtotal it all together and then look at them side by side.
I think the most common thing is people just want to make sure they're not getting taken advantage of and that they're getting a good deal. And when you don't know how mortgages work, how do you know if you're getting a good deal? And so your only way to do it, in my observation, and this isn't exclusive to mortgage, but it's to go in and negotiate as hard as you possibly can about anything that you could possibly point at to negotiate and try to beat up everyone and just be like, okay, I finally feel emotionally good about this. Yeah. And that's all it is. And the irony of that tactic is that you could beat up two guys that were wildly both taking advantage of you so bad from the beginning that after you think you both beat them up, you're still getting ripped off. The only way to not get ripped off is to just be educated.
Yeah, or going with someone that's a trusted advisor that has their best interest in mind. Yeah. It's like in the financial world, you know, and your firm's this way is, hey, I'm independent, right? I don't have an incentive to go to one company or another because I might get compensated higher or lower. So if you're going to that trusted individual, they're going to take care of you. And how do you find that person? You know, your realtor might be able to recommend that or somebody. And until you kind of get into that seat, you don't really know. But I think a lot of it is just the trust in that individual.
Ask your realtor how many transactions they've done with that mortgage lender relative to the number of times I've had lunch with them. That's it. That's it.
So what's the metric?
Sniff it out. Yeah.
More lunch.
I don't know, but if somebody said I've had lunch with them 3 times and I've done one transaction, I sent my last client over there, I'd be like, seems like he's buying you a lot of lunch for, let's go. What, you know, why are you really sending me there? You know?
Yeah.
I think Sean and I are alike though. Price matters and we want to give a fair, aggressive price to our consumers. But my ideal client is not the price shopper that's going to call 15 different institutions, because then it turns into this ping pong thing. And there's nothing worse than feeling like a used car salesman where and I see it all the time in the industry. You present a quote and they lower the rate an eighth. And then the next time they leave the rate the same and they lower, you know, a $500 fee. And you feel like this back and forth. I'm more of the mindset of if a consumer is going to do what you're saying and negotiate aggressively, I usually go down and say, hey, this is the lowest I can possibly go with the way that the margins and the way that my company is set up. Sure. Take it or leave it, right? I take the Carvana, or what's the other one like Carvana? They don't negotiate in price because they know that they're lower than market anyway.
CarMax or something?
It's not CarMax. What's the other one?
It actually went out of business.
I think it's Tyler.
Vroom.
It's gone.
Oh, I was going to say Tyler Ducharme at Wild Honda in Waukesha, Wisconsin. Yeah. I'm just kidding. But my little brother owns a dealership out there.
But you see my point. It's one of those, like, I just don't have the time and energy to do the whole back and forth when someone's leveraging me against 10 other lenders. Like, I'm going to give you a good deal. I'm going to give you, but I'm not going to do this back and forth thing. And then, because when you're doing that and someone's going back and forth and it takes over 4 or 5 days, the industry is changing what that pricing is too. So you're pricing a moving target. So
well, you're pricing a moving target and there's a deadline at the end that consumers don't realize that they're up against the wall sometimes on closing on that property this right way. So
I just want to highlight that, because telling a consumer just to become educated and negotiate like hell, I don't necessarily think that's the best advice either.
Yeah.
No, I agree 100%.
No, I'm highlighting. I don't think that is the best advice. I think it's a poor tactic is what I want to be very specific. I think that's a poor tactic. Yeah. What's better is to educate yourself on what does a fair deal look like? Mm-hmm. And how do I find somebody that's going to shoot me straight?
Yeah.
Right. And what are the red flags that I can watch out for? if, you know, I am starting to talk to people, what can I be looking out for? Where I go, ooh, yeah, they either may not have my best interest at mind. They may not have access to the right solutions. They may not know what they're doing. They, you know what I mean? Like whatever, a series of things, right? Because there's multiple aspects to what makes a good professional that can help you in a transaction or a financial situation where it matters. It can, I mean, this isn't buying a bicycle, right? It's just life-changing events potentially, right?
Yeah.
So,
yeah. And during the process too, it's who are they working with? So a lot of companies are set up, where you'll talk to a salesman at the beginning. They'll sell you a number, and then you're working with a processor that's getting documents. And then all of a sudden you're working with an underwriter, and then they might have an assistant, and then that person might have an assistant. So sometimes you can get into the process and talk to 8 or 10 different people. And sometimes that can create, duplication efforts. I got to send documents to a bunch of people. And then there's this emotional stress, and it's like, what is going on? Like, are they going to get the loan done in time? And so being able to work with, one professional or the team that's dialed in, like there's value in that too. Versus calling a 1-800 number and trying to get a status of like, am I closing tomorrow? Like, like my loan's closing, I still don't know. And I got to dial 1-800 and try and figure out if that's happening, so there's like an intangible value in who you're working with too during the process.
Yeah. Great advice.
So like, I personally would rather on buying a home or like a financial investment, or say I'm doing a remodel at my house, I would want to have that person's contact and be like, hey, I know that I can rely on them if something comes up during the process, Yeah.
Yeah. Just, it's hard these days to trust. I'm going to add, like, be careful trusting Google reviews is my own personal thing.
Sure.
Dude, you want to know a great tactic if you're new to an area, you don't have the relationships built up that you could get the endorsements on certain service providers, including mortgages. Call title company and say who are you working with that closes on time and the consumer is happy at the closing table. That's a huge indicator of someone that I would want to work
the industry, with. Title companies.
What's that?
The sleepers of the industry.
Yeah. Totally.
No one ever remembers to think about them and the critical role they play in the whole thing.
But I mean, you know who's closing on time. You know whose processing team, funding, closing is running smoothly. So there's the ops side, but there's also those that you can tell if the client was happy with the loan officer at the closing table. So asking for 2 or 3 of those names and using that as your base is very valuable.
Well, then sometimes too, I've heard title agents where the loan officer doesn't even show up at the closing, and then they're complaining, and then the title agent has to be like they got to
answering
take
the
the
question.
hit for it, Yeah. And so that's a really, really good advice, actually.
It reminded me of some advice. So I had a friend whose mom used to cut hair, and she said if you move to a new place and you want to get a good haircut, but you have how do you know who gives the best haircuts in town, right? Or like if you're out on a trip.
Why did you look directly at me when you said that?
Yeah, Ben, why do you how would you know who even gives a good haircut? So Sean, anyways, we're gonna have here's the trick, Sean. Okay, so this was her advice. You call up the like Great Clips or whatever, right? You call up the place that you're looking at getting a cut, and you say, "Hey, I came in a couple weeks ago and got a great cut. I can't remember the person's name. I know that she's so busy though. Can you remind me who that is?" And they'll immediately tell you who the best person cutting hair at the salon is.
Amanda, can I book with Amanda?
Yeah.
What does
Oh,
her
it's
schedule
probably
look like?
Yeah. That's exactly. And yeah.
Yeah.
It reminded me of that. That was a
clever way of doing it. But you're right. Title companies are the sleepers of the real estate industry. I kind of imagine title companies are those when you go to a party. They're the individual that's kind of standing on the outsides. They're not looking for the limelight, but they're kind of studying and watching everybody. They know everything that's going on.
And they see it all the way through because they're involved with communication, with execution, timing.
And there's less of them relative to at least in our local area.
Yeah.
Way less of them relative to the number of agents and mortgage lenders.
Oh, yeah.
Well, and then
So you'll find that like if there's how many do we have in town? Like, would you say roughly like 15 title companies maybe? There's probably like there might be
if there's more, the others are
they're like really
sleepers of
small.
the sleepers, right?
Yeah. Yeah. There's really probably like 6 or 7 big ones,
Sure.
and then another 5 medium size, and then it gets really small from there. There's in our county close to 2,000 or more real estate agents.
Mm-hmm.
They all have to use a title company on every transaction, more or less.
yeah.
So. Yeah.
Yeah. And to Ben's point too of the title company versus going through with your agent, sometimes the agent and the lender may have some sort of financial agreement. So that lender might be paying for the agent's leads. And so even though that
co-marketing.
lender might not be the best lender or the best, financial advisor to help them,
The
in that
agent
home
has a
journey,
conflict of interest.
There's a conflict of interest. So
Yeah.
the
Title
title
companies
company legally can't
do
co-market.
that. Yeah.
So they are like that independent, non-interested party. So that's even
That's some really good advice, Ben. I like that.
Sweet.
so a question in the financial world.
Okay.
So, it's this kind of similar conversation we're having is, do we really have the best client's interest at mind in the financial planning world? Like give us, I'd be interested to hear like your top 3 like questions or like what you're looking for, out for a client. Like how do you get into that conversation after like trying to help a client?
Yeah, I tend to not get too much into the conversation about like the questions people should ask. Not that I shy away from it. I just seem to. My attitude is somewhat more. You can look me up. I don't carry a complex system. I don't have a lot of hats I can be changing on you or something. So, I pretty plainly put it in writing for people that I act as a fiduciary, no matter what we're doing or how we're engaging. I have it in writing that I'll act in your best interest and seek your best interests at all times. That's probably the number one thing. But even beyond that, there's the conflicts of interest I think somebody should look out for. There's a company out there that has a lot of, they're an ETF provider. They also have a lot of different products, financial products available that people can utilize. And some of them are really cool. And some of them are, not my favorite. I don't like them or whatever. But this company is known in the industry amongst advisors that they have very deep marketing pockets. And so they actually, they had offered me recently, and they continually, it's a standing offer. They'll come to town and I can do a client appreciation event and take all my clients out for, steak dinner, and they'll cover the costs. And I have to pay, and then they'll reimburse, and you run it through compliance first, and compliance signs off on it. And there's just totally legal, even as a fiduciary. And I told them, no, I don't want to do it. And, they're like, what? Well, there's other people in town that take them up on this same very company. So they're kind of scratching their head. I said, I just don't want to be in a position where my clients would ever look at their statements or portfolios and have to even think to themselves, am I in this fund family because they paid for his marketing budget, or something? I don't want there to even be that potential friction point or conflict of interest. If we're in their products or we're using that company's products, it's because it's what's in their best it's what's in the client's best interest. No other reason, no conflicts for me. That's really, that's to me, that's like the big thing. And I do have conflicts of interest sometimes, right? If I write an insurance contract for someone, I make a commission, I just disclose it. And what I do is I lead with the planning. So if somebody says, hey, oh, you got a raise at work, we should get you some more life insurance or something. It's like, that's such a small piece of the puzzle that it's like you said earlier, and they're already recommending a financial product. You have to slow it down. So if I go through and actually do all the planning with people, and we are actually giving them a wealth management experience and delivering on that value, and we find a real need, it becomes really easy to say, this is what we would need to fill this hole. And I would recommend we try to find a product that fills this need, and then after we've agreed, I need a product that fits that kind of profile. Then we go to market, and even on the insurance side, I am independent, and we, depending on the product line, I typically can have 60 to 80 different companies, and we just go find the best that's available for that need for that client in that circumstance. And we can show them, here's the 3 to 5 best options, and do all the expert work. So even at that, there's a conflict in the compensation. I make a commission and I disclose it. And I've never had a client even concerned about that, because by the time we get to looking at product, they know they're buying it from someone, they know there's the need.
How do you help them discover that need though?
You got to ask good questions.
Yeah.
You have to ask good questions. You have to dig in deeper, and you have to care.
So that goes to your initial question, right? Like, what are some of those core questions you're asking the potential client when you're getting to meet them, right? At the very beginning, first appointment.
So I switched it's probably been 6 or 8 months now. Kind of my format for interviewing new clients, and I really switched to a format where I'm more interested in interviewing potential clients, at least on an equal playing field, that they're interested in interviewing me. And so in my first meeting, I tell people, no, I will not make a recommendation at our first meeting. I got no answers for you. I just want to ask you questions. I want to understand where you're at. After that, I'll do some analysis, right? And then I might have to come back with more questions, but I might be able to come back with some basic recommendations, and that's where we can start the conversation. But I take them through a series of questions. Like, one of my favorite questions in those meetings, when it's one that's kind of focused around retirement planning and somebody putting together those final stages of, okay, I want to retire in 5 or 10 years or something. One of my favorite questions is like, well, what do you want to do in retirement that you can't do right now? And it just seems like what a not financial question to ask, but it is, and it completely can change the dynamic of the planning that you do. Another really good one is, what's important to you about money, and thinking about that, right? And if somebody's answer to that may be, well, what's important about money is that my family's always taken care of. And then you're seeing a hole where you're going, okay, well, you kind of do some high risk activities and you have no life insurance and you don't have enough assets to self-insure. And they're just telling me that the most important thing to them is that their families, then that's where there starts to be clues, right? Like, maybe some term life insurance might be a valid conversation for me to come back and make a recommendation about them considering an option like that, right? Yeah.
How often do you stalk people on social media after that initial appointment?
Pretty uncommon.
Really?
Usually if they name drop a bunch of people that I know,
then you'll go creep on them.
Yeah, where I'm like, have I not crossed paths with this or yeah, but usually it's not. I don't have time.
I just think
how often do you do that?
There's a lot. It's usually random, right? It's not like I do it on every file, but it is very common that I'll go do a quick search. And a lot of it is looking for friends in common, but differing reasons. But I think activities, right?
And usually after they come in, usually after they've been in my office for a 45-minute meeting where I ask them all the questions about their life and all the most important questions that people will ask them, right? Like,
sure.
What is most important to you? Where's your money? What are you doing with it? What are your life aspirations? What are your legacy goals? All these things. I'm not really going to typically learn something on social media that they didn't already just tell me. But what I will do sometimes is look people up when I meet someone out and about and they got a big mouth, quite frankly. And I'm going, and
this isn't adding up.
Well, what's ironic is I can look them up sometimes, and there's a number of ways. I mean, you can stalk someone on social media. You can also, I have a software I can skip trace people and see all the mortgages they've ever taken out and properties they've owned and stuff. It's public information, and the stuff gets recorded, right? It's interesting. People, they're talking big, and I'm going, you filed bankruptcy 3 years ago. What do you? So that's a real thing that can happen. But one of the things I found, and I probably used to do that a little bit more. I just don't have the time now. But one of the things that I found is that the louder somebody kind of was out in public, and the more somebody would say in public that I got to come meet with you. And, the less they actually needed to come meet with me and the less intention they really had of doing that. The people that I found ended up, I met and have become just great clients, were the people that are just quiet. They're doing their thing. They're trying to make their best choices. And they say, yeah, let's get together sometime, and that's it. And then, you'd be surprised sometimes by the people that are around town that actually have wealth and net worth relative to who you think it is. Yeah. So
example of the book Millionaire Next Door. The majority of the wealth is in areas that you don't expect it to be. Sneaky.
It's very true here in St. George. You guys see it. You guys build enough 1003s to know exactly what I'm talking about.
I do.
Yeah. One of the first kind of like actual moments of seeing that in person was I had just got a random call. The guy was pretty like chill on the phone. He's like, oh yeah, I just kind of quit my job. I was the CEO. Like I just kind of want to meet and see where I'm at. And it was just like super low key. I was like, this guy does not sound like legit. Mm-hmm. And I could see he rolled up in like this Honda Civic.
Yeah.
And then we go through everything, and he's got like $6 million in like solid assets, and stocks, bonds, super diversified, just, quit like a $400,000 salary. And he was just like, so like normal, like just, well kept and stuff. Mm-hmm. But I was like, you would never guess this guy's got $6 million in the bank.
Yeah.
Right. And he had a bunch of property and stuff too. It's just like, you cannot judge a book by the cover.
I love that though. I love that.
But I've gone through so many iterations now that I've actually gotten pretty good at being able to profile people without them coming and sitting down almost to where I can almost pick that guy out at this point and know
how. I'm really curious on what would be the.
It's like a gut. It's a feeling. So I want to be super clear. I give everyone the benefit of the doubt. If somebody says they want to meet, I take meetings. I'll entertain a 15-minute meeting with just about anyone. And if it's something that, doesn't require my long-term help and they just need a little basic thing, I like helping people. I don't discriminate in that way, but I've gotten pretty good at being able to go when I meet someone and they say, yeah, I got a couple of things going on. Let's get together. And I sort of can probably put together most of their net worth statement with a reasonable margin of error, like without them telling me what it is. Like I can profile it.
Let me ask this question. What do you feel like with the clients that you work with? What is the most common financial waste?
Like in personal spending? Mm-hmm. I don't get into this. I don't get into the spending side enough in my own practice to probably give a valid answer to that. Other than I would have to take it probably as just like your leverage toys. Maybe that's probably that's the one I see the most common because it shows up on the net worth statement, right? The boats, the RVs, the side by sides. But I have a hard time saying that's a waste because when you really talk to people about it, sometimes that's the thing that is like their family's thing.
Yeah.
And so then is that really a waste? I don't know. I tend to work more with the demographic of people that we're not so worried about what the expenses are looking like. You're saying you're more often starting with the end in mind and identifying how much do we need to save or put away and get invested.
To accomplish that.
And they're making sure that that happens. And then now I don't have to like, I don't want to build a budget with someone. That's like there is few things in life less fun than building your own budget, but helping somebody else build their budget is one of them. It's like, most people, people spend money on all kinds of stuff too, but I just don't, I don't get into that conversation deep enough with people to really.
There's one that I thought was really impactful when I was scrolling through Instagram. And a guy was talking about I can't remember who he was, but he talked about coffee, people buying their Starbucks coffee every day.
Sure. And
the waste of clothes.
Yeah, see, but I think if you look at everything else in a box, you're okay, $10 for a coffee, let's call it 252 working days in a year, so $2,500 a year. If you're putting away $100,000, what's $2,500?
No, I agree. I just find it very.
It's all relative to your savings rate, really.
And it's okay to have a vice. It's okay to have a little bit of waste here or there because.
But is it a waste?
Meant to be lived? But it was a thought that the comment that he made on the Instagram post that made me think was. We tend to have the same 5 to 10 outfits that we use over and over again, but we look in your closet as chock full of clothes. And there's 80% of it that's never worn, or it was worn once or twice.
You got to see my closet. That's not the case.
it just was an impactful observation for me to go, oh, yeah, I can see that. So anyway.
Well, yeah. Clothes is probably one of the places that I've started overspending the last couple of years, but I enjoy it.
Yeah.
So,
well, thanks for having us on your podcast, dude.
Thanks for coming on. I know you guys are busy. You guys are both, for anyone listening, these guys don't even work together. They're just friends. They're good guys, in my opinion.
We usually hang out after 5 p.m.
Yeah.
That's what I've heard. I heard you hang out a lot after 5 p.m., but ironically before 5 p.m. in my office.
We have found ourselves over there recently.
Yeah. So anyone listening, Sean and I co-host a podcast titled After 5 p.m. Some of the backstory on that is we have previously worked together. And as anyone knows, when the day gets growing and the phone calls are coming in and you're jamming out to your duties and responsibilities, sometimes you have to wait until the phone stop ringing where you can bounce stuff off of each other. And Sean and I, for a number of years, we're just that, right? We'd poke our head into each other's office and have a mortgage question that inevitably would turn into conversation about family or finance, and a true bond was built there. So that's why we do the podcast. So if you've liked any of the mortgage conversation and content on this one, feel free to hop over and follow us over at After 5 p.m.
Facebook, Instagram, YouTube, and TikTok.
Yeah.
You can find us there.
Oh, yeah.
Where can they find you, Brandon? How do they find you?
All the same places.
All the same places. You're on socials.
I'm on socials. They can find me downtown at 50 East 100 South, St. George. Down in the office, I'm there all the time. Yeah. I mean, they're already listening to this, so whatever page this is on, Facebook, Instagram.
Click here.
Yeah, click here, follow the links. It's all good stuff. People can always get some time on my calendar if they want it, just by going to brandonducharme.com, and you can take 15 or 30 minutes and throw some time on my calendar. Somebody wants a phone call or a meeting or whatever. Ping me. If you need these guys' contact info, I'll get it over to you. Appreciate you guys.
Yeah, thanks, Brandon.
Thank you.
Appreciate it.
Investing in real estate and securitized real estate may not be suitable for all investors and may involve special risks such as limited liquidity and demand for real property. Changes in supply and demand for real property, change in law, tenant turnover or defaults, loss of investment, competition, casualty losses, use of leverage. Real estate values may fluctuate based on economic, environmental, and other factors. There is no assurance that the investment objectives of any real estate program will be attained. Any hypothetical example contained in this document are for illustrative purposes only. They do not represent the past or future portfolio composition or performance of any specific investment and are not intended as investment advice. We suggest working with your financial professional to see which allocation opportunities may be right for you. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than the original cost. Asset allocation and diversification are approaches to help manage investment risk. Asset allocation and diversification do not guarantee against investment loss. Past performance does not guarantee future results. Annuities are offered by offering documents which detail all fees, charges, and may be obtained upon request from your representative or insurance company. Read carefully before investing or sending money. Please see the offering document for restrictions and limitations. Some annuities, riders, features, and investment options may not be available in all states. Withdrawals may be subject to income tax, and if made prior to 59.5, a 10% federal penalty tax. The contracts contain limitations and the policy forms may vary by state. Annuities are generally long-term investment products designed for retirement purposes. Guarantees are based on the claims paying ability of the underlying insurance company. The cost and availability of life insurance depends on factors such as age, health, and type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable.